Remember the Evergrande scandal? Evergrande is now faced with more than $300 billion in debt, hundreds of unfinished residential buildings, and angry suppliers who have shut down construction sites. The company has started to pay overdue bills by handing over unfinished properties, and it has even asked employees to lend it money. But surprisingly, another monster financial crisis is now over China. In front of this monster, the Evergrande will look like some peanut. The monster is China's local government debts. According to the government, the amount is $2.3 trillion by 2020 and still mounting. Hello everyone, welcome to World of China, a channel to explore China. In today's video, we're talking about China's local government debts, which is causing massive instability in China's finance system. So stay tuned and give this video a big thumbs up. China's local government debt, or LGD, is like a mystery wrapped inside a puzzle. Few have exact information or estimate of its size. Neither the Chinese authorities nor investors have a regular way of defining local government debt, and there are no comprehensive records or reliable data. Many fortunes and reputations have been lost down the years predicting trouble for China. But this time really could be different. The tremors rocking the country's bond markets risks growing into a shockwave of emissions with the potential to destabilize the economy. For evidence that Beijing realizes it's drowning in debt and needs a lifebuoy, look no further than the government's actions. It's finally introducing a standard of pricing discipline into the corporate bond market, and it's actively encouraging foreign investors to help finance the reduction of a huge pile of bad debt. Local government debt in China is split into two parts, namely explicit and implicit debt. Explicit debt is local government on budget liabilities that are recognized by the central government, while implicit debt includes off-budget financing that's not recognized by the central government. Implicit debt also includes borrowing by local government financial vehicles, or LGFVs. What are LGFVs? Bonds sold by local government financing vehicles, or LGFVs, are one of the ways provincial authorities raise money to increase spending without including it on their official balance sheets. LGFVs flourished following the 2008 global financial crisis as a way of funding China's infrastructure building spree, even if they did not generate returns. The debt raised is kept off the balance sheets of local authorities, yet carries an implicit government guarantee of repayment. Now the question is, why local government debt is a big concern for China? Implicit local government debt, which the central government often referred to as so-called hidden debt, is seen as the biggest concern as there is no official data on the total debt sold by LGFVs, making it tricky to monitor. LGFV debt includes both listed and unlisted securities, as well as loans to banks. The report said in the future, banks too and insurers will refrain from providing fresh liquidity to those platforms that enjoy implicit guarantees from local governments and will block hidden debts from growing. Some projects backed by local governments have already been halted after failing to obtain bank loans due to tighter inspection. Public data shows local government debt leading at 25.7 trillion yuan at the end of 2020, but LGFVs have accumulated massive hidden debt that threatens financial stability, analysts say. LGFV financing platforms have increased rapidly since the global financial crisis in 2008, when Beijing rolled out a 4 trillion yuan infrastructure spending package to boost growth. But transparency is often poor, which has led to the misuse of funds and projects that don't comply with government guidelines. Local governments' deteriorating ability to pay off debts has been a long-standing concern, and the coronavirus pandemic only worsened their financial woes. While investments tend to be over the long term, most LGFV debt is around 3 years on average, which means a short-term cash crunch could trigger a fault. Over the past few years, a series of missed credit and principal payments have taken place at several LGFVs, which has already affected some local governments' ability to raise funds due to their weak credit profile. In November 2020, Yongcheng Coal and Electricity Holding Group, a mining operator owned by the Henan provincial government, defaulted on payment for a AAA-rated 1 billion yuan commercial paper, raising alarm bells that local government finances could be worse than previously expected. Since 2014, debt from the Public-Private Partnership, or PPP, a joint venture between the local governments and the private sector, has also grown. They tend to invest in the same projects as LGFVs. However, the growth of PPP has also raised anxieties over the potential misuse of funds because local governments fail to conduct return on investment evaluations and economic stress tests, which means projects may not generate any returns combined with a growing debt risk. Beijing's deleveraging campaign to control speculation in the real estate market and shadow banking activities has aggravated local government financial problems since it started in 2015 because most rely on land sales for income, and this is linked to the performance of the property market. Banks are among the biggest lenders to LGFVs, particularly through informal lending channels such as shadow banking. Financial institutions' significant exposure to local government debt could pose a systematic risk in China's state-dominated banking system, as there is a possibility of collective collapse caused by a bankruptcy of an LGFV. Let's take a look at the current debt situation. Local governments have been able to sell debt in the open market in the form of bonds since 2015. The balance of local government bonds reached 28.6 trillion yuan at the end of September 2021, accounting to 23% of all the listed bonds in China by volume, according to Huatai Securities. However, there is no official record of the debt sold by LGFVs. Local government hidden debts, mainly LGFV debts, including loans and bonds, reached 45 trillion yuan at the end of 2020, equivalent to 44% of China's gross domestic product or GDP, according to Lu Ting, the chief of China economist at Nomura. The amount is more than 4 times compared to the end of 2010. Economists at Goldman Sachs said in a report at the end of September 2021 that the total debt of China's LGFVs rose to around 53 trillion yuan at the end of last year from 16 trillion yuan in 2013. The report showed the debt is equal to around 52% of GDP. Local government debt in the form of PPP has also risen significantly, and since 2014, a total of 10,126 projects with an investment amount of 15.7 trillion yuan is still owed, according to the Ministry of Finance. Beijing has tried to better regulate local government debt, but its efforts have not been entirely successful, mainly due to the pressure on regional authorities to achieve economic growth, which is often fueled by infrastructure spending that doesn't immediately generate returns. This means debt carries on rising, while the bill to regulate local government debt and its related issues has not made significant progress since it was introduced in 2015. Beijing introduced special purpose bonds in 2015 as a transparent way to fund infrastructure plans in an effort to replace off-balance sheet borrowing by China's local governments. But the annual quota set by Beijing is not enough to cover local governments' total financing needs, leading authorities relying on LGFVs. PPP was also supposed to channel private sector money to support long-term investments by local governments when it was introduced in 2014. However, the Ministry of Finance tightened up its supervision over PPP projects in 2017 to prevent misuse of funds. But despite Beijing's effort to encourage the private sector to invest in PPP projects, there's still only administrative regulations in place that are insufficient to protect private investors. In August 2021, the Ministry of Finance said it would cooperate with the Ministry of Justice to push forward the long-stalled legislation covering PPP as soon as possible. In April, China's State Council said that LGFVs should restructure or go bankrupt if they're unable to repay debt, sending a strong signal that the central government may not bail out local government debts. While there has not been a high LGFV profile fault recently, especially those that are sold in the open market, analysts believe refinancing risks are high for local governments as a result of a potential prolonged slowdown in the property market, which is likely to hurt land sales and with it local government revenues. Some local governments have already introduced restrictions on the scale of the drop in home prices and have allowed local banks to slightly lower their mortgage rates and speed up mortgage approvals to avoid a hard landing in the real estate market, according to a report by Nomura in October 2021. The planned introduction of a property tax may also further slow down home sales, which can have an indirect impact on local government revenue. Land development remains important to the economic growth of most local governments, especially for smaller regions. Land revenues account for around 6% of total revenues for provinces, 42% for cities, and 39% for districts and counties, according to U.S. rating agency Standard & Poor. They're stepping up the restrictions on financing to local government financing vehicles to alleviate risks from hidden debt. Several banks and insurers are connecting their systems with a platform of the Ministry of Finance that monitors liability and expenditure of LGFVs, the newspaper said, citing industry sources. Local governments have been under pressure to boost economic growth through infrastructure spending via LGFVs, but the risk of failures has raised jitters in financial markets as Beijing has signaled it'll allow some heavily indebted LGFVs to fail. Local government investment companies were deeply disappointed by the new rule since banks play a key role in providing loans as the main source of indirect financing. In particular, the policy is expected to negatively impact those local government investment companies with hidden debts, forcing such firms to settle their debts. In order to resist rising debt, Circular 15 also requires local banking and insurance regulators to create emergency risk response plans to resolve hidden debts. Some local governments are already closely monitoring debt risks. PIC provinces have required that regulated products, including detailed repayment plans above the municipal level, be monitored monthly. The Institute of Advanced Research at the Shanghai University of Finance and Economics estimated in a report at the end of October 2021 that around 5.88 trillion yuan of LGFV debt will mature in 2021. This figure would be 5.6 trillion yuan on average in 2023 and 2024. The report by the Institute of Advanced Research says, at present, many local governments can only continue to roll over their debts by borrowing the new to repay the old. But this is just drinking poison to quench their thirst. It's not a long-term solution. Standard & Poor believes the central government will be more selective at bailing out LGFVs and state firms going forward, as Beijing is determined to control the growth of hidden debt by local governments. In a report at the start of October 2021, Standard & Poor said that the LGFV sector will see further deepening of credit differentiation, and issuers with deficient financial management and government administration could face mounting refinancing pressure. One of the major issues with local government debt is that local governments have been taking on new debt to repay old debt, rather than investing in new infrastructure projects. This is because a long period is required before infrastructure projects such as shantytown renovations or park constructions can become profitable. Refinancing bonds accounted for about 56% of the newly issued local government bonds, up from 20% in the past 2 years. Bonds used for refinancing have crowded out bonds used for infrastructure projects to some extent. Already, infrastructure investment declined 3.6% year-on-year in May. This decline, as well as lower project yields, will result in lower infrastructure growth for 2021. Furthermore, the Ministry of Finance issued the local government special bond project fund performance management measures in July to further regulate the use of funds and prevent debt risks. Local governments' special purpose bonds are required to be linked to performance targets for the related bond projects. Project supervisors must carry out a performance evaluation before obtaining authorization to issue the special purpose bonds. The new regulations aim to develop the quality of local government infrastructure projects and to improve capital efficiency. This is because the government audit work report found that many special bonds have not been used for their stated purposes. The government has also indicated that it would not bail out local governments, which has led to nervousness among those invested in local government financing vehicle bonds. Experts have underscored that the aim is not to end local government investment companies, but rather to improve the health of the industry. Well, that's all for today. Thanks for watching the video. If you like this video, then give this video a big thumbs up and share it. For more exciting videos, subscribe to this channel and hit the bell icon. I'll be back with another exciting video soon. Till then, check out our channel for more exciting videos and stay tuned. Check out the full story of the Evergrande scandal. The link is in the description.